Hey everybody, this is Jose Blasco. I'm about to get started. Just a few seconds, 1 minute, if any, and we begin. Thank you so much. Great. Very good, everybody. Welcome to the session, everybody. Today is June 13, 2022. My name is Jose Blasco. This is the SMARTT Tiger Live special session that we have for you guys. So let's dive in. Okay, we're gonna look at financial markets. Of course, we're gonna use a lot of options data to do our analysis. That's why our market analysis report is special. We are not simply looking at candlesticks or fundamentals. We go beyond that. So we're gonna be talking about that. Okay, but before we get started, as always, a disclaimer on the upper left side of the screen. You can see our financial disclaimer. It's fairly short. So I am counting on you all to please read it carefully and completely, as a financial disclaimer is indeed something important. So I'm counting on you to do that. Also, as we are getting started, as I am assuming that some of you are connecting one at a time and entering the live session, both in the Tiger Broker app as well as in the YouTube channel. I would like to invite you to say hi on the chat box. This session is designed to be interactive for us to work together, for me to be able to support you. I need your interaction so I know better what you need. So please, let's have a quick trade between us here. The trade is I support you, and in exchange for that, you guys are engaged and interactive with me so I can actually support you, okay? So just like in trading, yeah, there is a buyer, and for every buyer there is a seller, and vice versa. So this is our little trade here. So please, let's go ahead and let's have a quick check to see if the order got filled or not. Everybody say a quick hello on the chat box, so that way I know you are there. By the way, I am watching both the YouTube channel as well as the Tiger Broker app. So just know that wherever you type your questions, I'm going to be seeing them and therefore providing you with answers and support during the session. Very good. Perfect. So again, my name is Jose Blasco. You can see my email on the screen. I will share that information as well towards the end, in case towards the end you have additional questions that you would like to ask. I'm happy again to support you as well during the session as well as after the session is over. The agenda for today, I'm going to quickly introduce myself, just so you know who I am, who is Jose the trader. Really, the session is about you, so I'll keep it short. And then from there, we'll move into headlines, option lesson for the day, and the market commentary. I have a bonus for you. I'm not the only one with a bonus for you, to be honest. You can see there is also a QR code. This is a bonus from Tiger Brokers. So please take a screenshot, grab it. If you haven't grabbed it yet, this is a zero commission card for you to trade options on the US markets. So nice one to have. Don't miss it. How are you, Queen V? Good to see you. Everybody else, this is very nice. Thank you so much for that engagement and interaction. As I was saying before, it's critical for me to help you more. Okay. Very good. Anyway, so let's begin. My name, Jose Blasco. What do I do? I trade. What do I trade? Everything. Why? Because I love the markets, and every market got pros and cons. So I like, depending on what I'm trying to accomplish, either a long-term trade, a short-term trade, more leverage, less leverage, larger account, lesser large account, whatever that is, I utilize the assets that work the best for whatever my goals are. Having said all of that, my preference in trading by far is options. Why? Because options give you options. Options give you choices. You can be directional, non-directional, and so many more things that we'll be discussing one lesson at a time as we are spending time together in these live Tiger Live sessions. Okay, so again, if you are passionate like me, or you are about to become passionate about trading, just join me, work with me, and we will help you as much as I can to develop yourself as a trader. Okay, cool. Our company, tradewithufos.com. If you have not seen our website, I would like to invite you to go and take a peek. Our website is called Trade with UFOs, where UFOs, they look like flying saucers on the chart. Later, I will share charts real time so we can analyze the markets together, actually. And you will see those UFOs, like what you can see on the screen, that little screenshot on the top. And those flying saucers that look like UFOs, they actually represent on-field orders to buy or sell, and therefore they can be used to improve the precision of your entries and exits when trading for all markets, all trading styles. And again, it's pretty powerful stuff. Okay, it's a technology that we have patented, and you can take a look and learn more about it on the website. And for sure, if you have questions, I'll be delighted to answer. Okay, but we need something else to address today in our session, so I'll just keep going. So headlines, my friends. Today, it's a pretty powerful day. Okay, I'm not sure if you guys, some of you, I would expect maybe you've been busy in the office working the whole day, and this is now your time for you to look at the markets. Some of you, maybe you have been looking at the markets throughout the day. You know, you may be in different situations, right? But for the ones of you that have been watching the markets today, I mean, you tell me what has been happening in most markets globally, like most markets globally. What has been happening? Well, major moves. Okay, major moves, and one of the items we have on the headlines is strong US dollar weakening most markets. Markets out there across the board, they are being hammered in a major way, which is not necessarily a bad thing, especially when you trade options. You know, you can profit very well to the downside, and the markets move faster to the downside. So it's actually a nice skill to have. But in any case, why is it that those markets are just crashing like the world is ending in many places? Well, it's very simple. The dollar is strengthening. Later, I will share real-time charts. I will show you the chart of the dollar index. The dollar is becoming very strong. And what happens when the dollar as a currency is very strong? Well, what happens is that to buy the same stock, you need less dollars because the dollar is stronger as a currency. So what happens to the price of assets? They go down. You can see the Bitcoin has been down, like, let's call it 10%, rounding numbers today. You look at, you know, other currencies crashing too, commodities, you know, moving, you know, and the equity markets, you know, the S&P, which we will analyze in a moment, it's set to open around 2% down. And this has a lot to do with the strength that is building up on the dollar index. We're going to see later the UFOs on the dollar and everything else, and you'll see what I mean. So again, of course, Russia, Ukraine, this is obviously something that is indeed out there and still impacting the markets. The fact that the US is trying to fight inflation, raising the interest rates we've talked about in prior sessions, obviously is one of the fundamental reasons for the dollar to be becoming stronger. Why? Because if you raise the interest rates, then buying bonds which are denominated in US dollars is going to pay you more because the interest rates is higher, and therefore there are many monies that were sitting in cash that were doing nothing that now are actually buying US dollar, and next thing you know, the dollar is becoming stronger. So it's all related, it's all connected. Now, the one thing that today I have very little to comment on is the earnings reports. We almost always have some earnings reports that are relevant to mention. Today, we have 123 earnings reports that will be reported. And the reality is that most of them belong to relatively small size or mid-sized companies, which are not that relevant. No, there are no companies from the S&P 500, for example. So therefore, you know, just to be pragmatic and simplistic, I just put on the slides there, nothing too relevant today. Okay, so again, the very big news today really, it's what's happening to the US dollar. That's the really big news, which more than a news that you can read on a newspaper or some news website, it's really something that you could observe on the charts, as I will show you later. Very nice. I'm going to keep going now here, but for the ones of you that just joined the session, please say hello on the chat box. I'm watching you. Say hello on the chat box so I know that all is good with you guys. Chat box is working so I can answer your questions because we are about to start the lesson. And this is where now you may start having questions. Okay, so lesson for the day today, the title of the lesson is Credit Spreads and Credit Spread Applications for aggressive and also for conservative traders. So credit spreads are a typical option strategy, which is very, very popular among many traders that trade options. But the key, and this is going to be one of the spices for today's lesson, is that depending on how you construct such credit spreads, they may become very aggressive or they may become quite neutral and conservative. So we need to understand that better, and that's why we put a lesson together so you guys have the opportunity to learn this, okay? But some of you attending the session today may be thinking, okay, but wait a minute, what's a credit spread? Okay, well, a credit spread is an option strategy that utilizes two options at a time, okay? Either two calls or two puts. And one option contract is sold, The one we sell is the one with the higher premium, okay? And one options contract is bought at the same time, and the one that is bought is going to be of a lower premium. What does that mean? Well, it means that while both are going to be calls or both are going to be puts, the one you buy and the one you sell are not going to share the same strike. How are you, Roger? It's very good to see you. Thank you for that hello message. So in other words, for example, let's say you buy calls and maybe you buy the 50 call. Okay, so maybe your credit spread would be made of buying the 50 call and selling the 49 call. So the call you sell is below, the call you buy is above. And because the lower call has more premium, you collected higher premium for the call you sold and you paid less premium for the call you bought. Therefore, the net result is a credit. Okay, we talked about credit strategies in prior lessons. So I would assume that you are following what I'm saying. If you happen to have missed prior lessons, I would totally recommend you to go ahead and watch the recordings either on the YouTube channel or inside the Tiger Broker app, so you can catch those recordings from the prior sessions and make sure you understand this concept because it's quite useful. So if you were to do puts, right? So you sell a put, you buy a put. So if you sell a put of a higher strike, for example, you sell the 50 put, and then you buy the put from the lower strike, you buy the 49 put. So the 50 put has more premium, you sell it, you collect high premium. The 49 put got less premium, you buy it, so you pay less. So again, the difference between what you sold and received versus what you paid and let go from your account, it's a credit. And therefore, those strategies are called credit spreads. Okay. Now, when using calls, the credit spreads are going to make you bearish. Okay, and we'll talk about that there are different degrees of how bearish you're going to be. Okay, that's why in the title of the lesson today we are talking about being aggressive or conservative, because you may do a call spread which is bearish, but you do it in a way that is quite neutral. Okay. There will always be a little bit of a bias of bearishness in it. When you do credit spreads with calls, there will always be a little bit of a bearishness inside, but it could be very much neutral, which makes you very conservative, or it could be very bearish, which then it makes you much more aggressive. Same happens with the put credit spreads. When you do put credit spreads, there will always be a bullish component. But again, depending on how you construct it, those bull put spreads or bull puts, they will be quite neutral or they will be quite aggressive and therefore very directional. Okay, so we'll talk about that in just a moment. So far, you now know what's a credit spread. Now, credit spreads have limited reward. Like all credit strategies, including the most simple of all credit strategies, when you sell a put or you sell a call, when you sell an option, you get paid premium. What is the most that this trade can pay you in the end is the credit collected. If you sell an option and you get paid 5, the most you will make is 5. If you sell an option and you get paid 2, the most you will make is 2 because it's the credit collected, right? Makes sense. So when you do credit spreads, you sell an option, you buy an option, the differential is the credit. Let's say the credit is $75. So then the most you can make on that spread is $75. Same concept compared to selling options naked. Okay, so this opens the door to being directional, but it also opens the door to being neutral. And you will see why. Because let's say you sell an option very close to the current price. So of course now, depending if the stock goes your way or against you, the trade will profit or lose. So you are quite exposed to the risk of market movement. Where let's say now you sell a credit spread far away from the current price, what is normally known as out of the money. Well, if you sell a credit spread far away from the current price, while having the stock move against you is not a good news, it would take a long movement against you for that credit strategy to start really generating pain in your account. Why? Because it was positioned far from the current price. So therefore, now you are more neutral. You don't necessarily want the stock to move in your direction. You are just happy with having the stock do whatever it wants to do. As long as it doesn't move too much against you, then you're fine. So that's what we call being neutral, which is not necessarily needing the stock to move in a specific direction. You just need the stock to not to move too much against you. right? So it's two different approaches. One utilizing in the money units, ITM, which is more aggressive. The second choice, which is more neutral, more conservative, is utilizing out of the money units, which is more neutral. And by the way, I have, I think, a couple of slides left, and then I will move into real-time charts so I can actually demonstrate how to put together a credit spread to be aggressive and directional, and how to put together a credit spread to be less conservative and therefore less directional. Okay, I will do both so you see how it's done. Okay, but first I need to lay out the key concepts so we speak the same language before I do it, so it's well understood. Now, with directional credit spreads, okay, what you would do, okay, or when would you enter such trades? Well, you would do it if you expect the stock to move, to begin trending, and ideally to reach a specific price target, right? So it's like you're looking at, a specific stock, and you're like, okay, I think that stock is going to reach 75, and the price of the stock, let's say, is currently trading at 60, right? So the stock is trading at 60, and you're like, okay, my analysis tells me it's going to go up, it's going to start trending up, and it's going to reach all the way to 75. So you have a target at 75, and it's going to take a while to get there. That's why I'm talking about the concept of trending, because it's going to take a while, and we all know that trends tend to last unless there is no trend, and we are dealing with a sideways market. When a trend establishes itself, it tends to last, and that's your opportunity to get from 60 to 75 in this made-up example, right? So let's say you have this view as you do your market analysis, no matter the trading techniques that you employ. I am a UFO trader, so I use UFOs, but I would assume that everybody here in the group utilizes different trading techniques. I'd love to get you introduced to the UFOs, but fair enough, if you use other techniques, the application of option I'm discussing with you applies to no matter which is your trading method, okay? So what would you do if you have that expectation? The stock is going to go from 60 to 75. Well, you will want to use in the money options, right? Because in the money options have more premium compared to the out of the money options. So you would sell in the money options, okay? You would collect plenty of deltas and plenty of premium. And if the stock moves your way, then your profit would be the net credit collected. Remember, the most you can make when you do a credit trade is the credit collected. So the most you would make is the credit, but because you're using the money option, so you maximize the amount of credit to be collected as well as the amount of delta. And therefore, when you get to the target, you are supposed to be a happy trader and the trade is over, okay? Now, if you are doing this to be bullish, okay, like in the example where I mentioned going from 60 to 75, so then you would do what we call a bull put spread, which is the case below, which is made of selling a higher strike put. That's typically where the directional target is, or close to where the target is, and you would buy a lower strike put, which is going to be giving you some protection and limit the risk of a credit spread. Probably you all know, going back to options basics, and if you don't, listen carefully, that when you sell an option, you have a theoretical unlimited risk, right? Which, again, unlimited is a very big word, but based on mathematical terms, that's what it is, okay? So what happens when you sell a put? You got theoretical unlimited risk. But what happens if you buy a put together with the put you sold? Well, the put you bought protects you from the risk of the put you sold. And therefore, your risk is now limited, as you will see later in the real-time example I will put together. And now if the stock goes up, you're going to make a profit, which maximum will be your credit, okay? What if you do the bearish approach? Okay, so same story. You do your market analysis. Your view is that the market is going to fall. So you do a bear call spread, okay? So then you buy a call at a higher strike. That's going to give you protection. You sell a call at a lower strike. That's your bear call spread. And that is going to produce a great credit because in the money options, are going to pay you good premium. And then if the stock falls, you will be a happy trader, okay? This is how you approach your credit spreads to be directional. If you want to approach your credit spreads to be neutral, okay, you would use out of the money options instead of in the money options, okay? And please, at this time, I would really like to get a little bit of feedback from you guys. Just a quick confirmation, guys, even if it's just to type a quick okay or all good on the chat box. Please give me some feedback that what I just explained about being directional with in the money options and being neutral with out of the money options, it's understood. And if you don't know what's in the money, out of the money, please let me know as well, because I have no problem to explain that quickly. But that's quite critical, because it's, while the strategy is credit spread, it becomes a totally different animal depending if you use in the money versus out of the money options. Okay, so I would really like to know that. So when do you use neutral credit spreads? Well, then that's when you expect the stock to stay above or below a certain level without necessarily trending in a specific direction. So maybe you're looking at the stock, you do your market analysis. Thank you so much, Queen V. That's very appreciated. You do your market analysis. Maybe you see a very strong support, a very strong resistance, and you're like, well, there's no way the stock is going to break that price level. Or maybe, it's a price range and you expect the market to range. Or maybe you expect the market to trend, but instead of trying to profit from the trend movement, you just want to be more conservative and sell further out of the money options and, rely on the trend, but without trying to reach a target, just expecting the market to not to go against you by too much. So all of those scenarios would be valid to call yourself a neutral trader. And if you were to do that, then what you would do is sell those out of the money options, which means that they are far away from the current price. And that distance from the current price to the strike price of the out of the money option creates a buffer that allows the stock to fluctuate by a certain amount, which would not hurt the P&L of the trade too much. Of course, if the stock was to fluctuate by a lot against you and go beyond your strike, which was out of the money when you started the trade, but now the price went beyond your strike and now the out of the money strike is now in the money. So then, of course, now you're going to get the full loss of the trade, which again is going to be limited, because when you do a spread, you sell an option and you buy an option again, and the option you buy against creates protection. So you are not going to lose unlimited. The size of the loss is going to be very limited, actually. Again, I'll do a couple of examples in a moment and you will be able to see that. And, it's totally fine. It's not the end of the world. It's part of trading and that's it. But again, that's the nature and that the very different behavior of those trades and the consequence of using out of the money options versus in the money options is really a dramatic difference, because with out of the money options, really, you can see the stock move against you by a certain amount and really your P&L is, minus $10. It doesn't really change too much. Where only if the stock really moves against you, like consistently for multiple days in a row, keep going against you, now your P&L looks ugly. But you had to assume all that crazy amount of movement against you to see the pain. Without all that crazy movement, you would not have seen the pain, okay? Now, of course, you are guessing it, and if you're not, let me tell you, the disadvantage of using out of the money options is that the net credit you would collect will be much less compared to the credit you would produce with the directional credit spreads within the money options. You get more credit within the money options. You get less credit with the out of the money options. You also have a more conservative approach and theoretically less risk with the out of the money options. You also have a more aggressive and therefore theoretically a higher risk with the in the money options, which of course is fair. This is trading. The more the risk, the more the reward, the less the risk, the less the reward. It's a natural thing, that we see all the time with the financial markets. So time for me to move to real-time charts and demonstrate and illustrate all those points. Before I do that, I told you I have a bonus for you. So here you have it on the screen. Take a screenshot. Here's the QR code, or type tradewithufos.com/aclimate. What is aclimate? Aclimate is one of our technologies, which is AutoClimate. There is a coupon code called Claim 8 that you can see on the middle part of the screen on the left. Claim 8, don't miss that one, because if you go to our website, you will see that AutoClimate has a cost where when you add that Claim 8 coupon code, then it becomes free for you. And this is thanks to Tiger Brokers. So thank you very much, Tiger Brokers. Don't miss your coupon code. And then you can get into our website and you can get AutoClimate for free inside TradingView. Okay, so I'm gonna move now to the charts. And by the way, you may be thinking, what's AutoClimate, Jose? You never explained what's that. Well, you're gonna see me use it in a moment, so you will understand what it is. But basically, it's gonna tell you about the climate in the market, so you know if it's time to be a buyer, if it's time to be a seller, and that together with the options or the UFOs really is quite powerful stuff. Okay, so you're gonna see that in a moment. So let me move. I'm gonna stop sharing. Okay, you're gonna stop seeing my screen for a moment. And as you stop seeing my screen, I am about to share my other computer screen, where you will be back to see my slides, which I believe you do. And the first thing I want to do, actually, let me do this. This is TradingView. Okay, this is TradingView, and this below it's auto climate. Okay, so you can see, for example, this is the dollar index, which I was telling you. Look at the strength on the dollar index. Major strength on the dollar index following the prior impulse. We're having a new impulse that is starting. So if we surpass this very key, very relevant pivot high, we are set potentially for another very strong push on the dollar index, and therefore potentially a continuation on the correction of the S&P 500 index. Okay, so we're going to see that. In any case, in the bottom part, you can see the climate being blue color, telling you that the climate is likely going to continue moving to the upside. Okay, the dollar index, sorry, is likely going to continue moving to the downside. Okay, so with that in mind, what did I do? Because everything has a lifespan, isn't it? Nothing lasts forever. Okay, so what did I do? So I'm looking at our platform Top. Okay, in case you don't know Top or you have never seen Top, Top is what we call our predictive options planner. Okay, it's our predictive options planner. We call it the Top platform. And what I'm doing here, I'm doing something that, if you guys allow me, even though it may sound a little bit overconfident here, but it's okay. I'm basically trying to be smart, okay? And what I'm trying to do here is I am adding two specific filtering conditions where, number one, I am looking at a continuous implied volatility spread, which have the greatest increase in the last 5 days. So in other words, I'm looking at, of all the 9,000 stocks in the US market, I'm looking at the ones that have options that got the most expensive in the last 5 days. But also, apart from that, I am also looking at, I said that backwards. Let me rephrase that, guys. The implied volatility, the greatest increase in implied volatility is the word mean, okay? So the implied volatility mean, the greatest increase in the last 5 days, is the bottom condition. Sorry for that, not the top condition, the bottom condition. And what I'm looking at with the top condition is the greatest increase on the CIV spread. So what is the CIV spread? Is the continuous implied volatility of the calls compared to the continuous implied volatility of the puts. The difference is the spread. So why is that interesting? Well, because if the implied volatility of the calls is much greater than the implied volatility of the puts, or another way to say that is that the implied volatility of the puts is much lower than the implied volatility of the calls, that can only happen because of two reasons, which is either more people are buying calls or more people are selling puts. And both buying calls and selling puts is a bullish thing to do. So in other words, I am looking to find stocks with a bullish sentiment that is building up in the options prices. And with that in mind, I am also below filtering with the auto climate for climates that are down and that are late. So what is late? Well, we have early, sensible, hopeful, late. So early means the climate just started. Okay, so the climate is going up or the climate is going down and it just started. That's early. Sensible means it's been running for a while, but getting in now, it's sensible. You are not late to the party. Hopeful means that getting in on board now is too late. If you think it's going to continue, you are hopeful. It may continue, but it's unlikely. And late means it's surpassed over 2 standard deviations of what hopeful is. So you are extremely hopeful that it will continue moving in that direction. So that's what's happening to Pepsi, for example. Pepsi is a company that has been falling for way longer than what statistics would suggest. I know this thanks to autoclimate. But on top of having been falling for longer than what statistics suggest, we find now in the options world, we find options data that reveals that options are expensive, so I want to sell them and get a very hefty, juicy credit, and the implied volatility of the calls is greater than the puts, which is a bullish sentiment building up behind the scenes. Okay, so then what? Well, I'm getting ready to buy that stock. Okay, and again, this is just me sharing with you some of the techniques that I use in my trading plan. This is obviously not financial advice, but hopefully it's a good exercise and a good application of trading techniques and credit spreads following up our lesson today. So now, the last price of Pepsi is 162. In other words, when the market opens, it's going to open down here at 162.50. With 152.50, it's inside of a green UFO. So my expectation is that the market opens with a gap down inside the green UFO, and from there, Pepsi will start moving higher. And because that stock is revealing to me that he's been falling for too long, and that stock is revealing to me that in the options markets, we got buyers coming in, thanks to the filtering conditions I showed you a moment ago, I am willing to put together a credit spread in case number one, being aggressive. So I want to do it now, right? So what am I going to do? Well, I'm going to come in here, okay, looking at that UFO and looking at the red UFO above, okay, around 170. So if I'm going to be aggressive, I could go ahead and sell the 170 put, okay, and below buy protection. Not sure what will be available. I will guess 165 should be available. So maybe I could sell the 170, buy the 165, and get myself into an aggressive credit spread. Okay. So let's take a look. Okay, that will be my aggressive credit spread, selling the 170, buying the 165. Okay. Now, what if I want to be neutral? Well, if I want to be neutral, instead of looking at a 55-minute time frame, which is intraday trading, I may look at something a bit more long-term, like the daily time frame, where I can see I got UFOs down below, right? So in other words, if this market was to fall and fall and fall and comes to the UFO, it will likely go back up. So what am I going to do? I'm going to sell, okay, a spread down below, or if I want to be even more conservative, down below that UFO at 150. So let's do that. Let's be very, very conservative. So if I'm very conservative, I'm going to do a conservative credit spread would be made of sell the 150 put, okay, and buy, I guess I'm going to find the 145 put. Okay, so if I was to do that, so this will be my trade, where one would be more conservative and the other one would be more aggressive. Why? I'm calling the one above aggressive because the only way to profit in the one above is that Pepsi needs to start moving higher. If Pepsi doesn't move higher and it just goes lower, immediately I'm going to start losing. And what's the most I can lose? We'll see that in a moment. It's going to be, the risk of the trade, which I'm going to calculate in just a moment. Okay, but I'm going to lose immediately because I'm directional. I'm aggressive. Now, what if I do the second one, which is conservative? Well, if it's conservative, if I'm conservative, now I could afford multiple things to happen. Pepsi starts moving higher, and I profit. Pepsi move sideways. Okay, on the expiration date, I still keep my profit, so it didn't go anywhere. On expiration, is at the same price level. Doesn't matter. I make the same profit. Okay, my credit is my profit, even though it never moved in my direction. Or Pepsi move a lot against me. Okay, but stays right above 150 on the expiration date. Guess what? I still make my credit. Why? Because I didn't go below 150, which, by the way, is unlikely because of the UFOs. But again, of course, if it was to happen and the stock was to go below 150, now here I am at a loss. Okay. So you can see how the conservative credit spread allows you for profits to be made not only if the stock moves your way, but also if the stock goes against you for a while. Okay. Now, of course, the amount of profit is going to be less. So let's build it. Okay, let's build it. I'm just going to build an option chain here. I'm just going to bring an option chain very quick. I'm just going to keep it very simple here. So I'm going to look at the first approach, which was the 170 put. Okay, combine 165. Okay, so this is the first approach. So let me project it. Okay, so here's the approach. Okay, so on the top, I got the P&L of the trade, and here's the chart of Pepsi. Okay, and here are the dates, and therefore this is the expiration date. Okay, so what happens if on the expiration the stock is below 170? Well, then I lose. How much I lose? Well, in this case, $33. What if the stock drops by a lot? I lose up to 166. The most I can lose is 166 in this trade. Okay, so if you were to take this trade per contract, the most you will lose is 166. If you do it 10 times, the risk is 10 times. If you do it times 5, the risk is times 5. If you do one contract, it's 166. Okay, now what if the stock moves your way? Okay, so notice that through time, if the stock moves your way, okay, if the stock moves your way, profits are being made. Okay, so if the stock is trending, the more it goes up, the more you make. And of course, on the expiration date, okay, on the expiration date, you make your maximum profit, which is 334, which is the credit collected. As you can see here, the credit collected when you do the trade, you sell the 170, you buy the 165, the credit collected is 334, so the most you can make is 334. Okay, so if it goes your way, you make the credit. If it goes against you, you lose, like a normal trade, if you wish. Okay, the only characteristic is the fact that being a credit trade, the most you can make is the credit. Okay, now what if instead of doing this trade, which is the aggressive one, what if you do the conservative one, selling the 150 and buying the 145? If I sell the 150 and I buy the 145, again, let me project the trade. Notice that even if the stock stays the same all the way to the expiration date, okay, this is the expiration date, okay, and this is the current price, 162 something. Notice that you make $49. What's $49? $49 is the credit collected. Notice the credit collected now, it's not 334. The credit collected now is 49. Why is it less? Because you're using out of the money options. You are not using in the money, you're using out of the money. And therefore, the credit is less. Okay, but the risk is also less. Notice if the stock stays the same, you make the profit. If the stock goes against you, even if the stock goes very, very close to 150, you still make 49. Okay, of course, depending on what happened during the life of the trade, the P&L will change. Depending on what happened during the life of the trade, okay, the P&L will change. Okay, notice that even when the stock moves against you by a little bit, you see that? The P&L doesn't change too much. That's what I meant earlier. You see, the stock is constantly going down, 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 but the P&L is kind of like going flat. You just got a little bit of pain. Only if you have a severe move against you, something like that, that's when you're going to get the loss. Okay, and how much is the loss? Well, the most you can lose is the difference between strikes. 150 minus 45 is $5. Okay, so $5 times 100 equals $500 of risk. Okay, but the risk is diminished minus the credit received. Okay, which is $49. So 500 minus 49, that is $459 of risk per contract. That's the monetary risk of the trade. That's the most you can lose. And you can see at this moment in time, that's exactly where we went. Okay, why? Because the stock went against you like all the way, like crazy. Okay, but even if the stock went against you more, you cannot lose more than 451. Why? Because the put you bought protects you against the put you sold. Okay? Anyway, hopefully this makes sense. Let's go now ahead and move into our market commentary, so we can do our SMARTT analysis of the markets. Hopefully this lesson was eye-opener. Again, little by little, as we are conducting lessons together, guys, we'll add more and more and more and more, so you become more and more an expert with options. But if you have any question, please feel free to type. I'll do the market commentary now, And after I'm done, I will come back to read your questions and give you answers if there is any question related to the lesson. Or guess what? If the lesson went well and it was helpful to you, it'll make me very, very happy to read a kind message from you on the chat box saying, Jose, thank you for that. Or Jose, now I get it. Anything like that will really help me to understand, because again, every month when we get organized to bring to you some lessons, the question is, what do you guys need, right? I'm happy to teach you anything you need, but I don't know what you need. So if you could teach me more, if you could share more with me about what is it that you need for future lessons and how did it go with today's lesson, that would be extremely helpful to me, but I guess that indirectly or directly also to you. Okay, so let me know, please. Do not be a stranger. Anyway, so going back to our market analysis, again, where are we at? I'm starting now with the S&P futures. The S&P future is currently down by 2.44%. I have the S&P future here in the large chart on the right. On the left, I got SPY, which is the S&P 500 index. Is extremely useful to, ideally avoid to be on the right side of the market, and the market is now pointing to go down. So careful with that. And also from an options data point of view, our SMARTT approach to understanding the markets tells us gray line, implied volatility of the puts, above blue line, implied volatility of the calls. So in other words, there is a bearish sentiment overall on the whole S&P 500 that we can see not only on the price movement falling, but also on the fact that the options data shows and reveals that puts are winning the battle against the calls. Okay, so very, very careful with that. Now, good news, there are some green UFOs below price, but not really good news, because the opening price of the market is going to be 381, which is below this green UFO. In other words, those green on-field orders have been consumed during the future session, which runs for 23 hours a day. The SPY that only trades during market hours, which is 6.5 hours a day, basically got those orders consumed in the futures arena. And therefore, those on-field orders that show on the screen are not relevant at all. Okay, price is going to happen below. So again, there is room for the markets to fall. And again, we got to respect that, because that's what's happening out there, my friends. Okay. From a market volatility point of view, to be honest, options data, options prices are not cheap, but not that expensive yet. Of course, today with the crash today, I would think that options prices are going to become much more inflated. So you are likely going to see that red line beyond the blue lines in just 1 day or two. So again, the next UFO is located all the way at 358. So my friends, is not that far. Okay, if we do the math from 389 to 358, so we're talking about $31 divided by 389, that's 8% down. Okay, so 8% down at a rate of 2% a day, you just need half of a week to get there. So we could certainly get to those lows fairly quickly. Okay, so if you are planning to go long, I would say just make sure you know what you're doing. Just make sure you wait for the right indications, because the market is set in a very, very bearish tone at this moment in time, which again, with options, it's a source of great opportunities. Of course, for the ones of you holding stocks for the long term, probably it's a matter of a little bit of patience, or a little bit of resisting the pain, or maybe averaging down, or whatever your techniques are. Everybody's different, and again, this is not financial advice, but just know that the market is set in that condition. And yesterday we saw clues of this happening as well, with 2.6 times more puts traded compared to the calls. So again, very, very bearish components that are entering the market as we speak. Okay, So with all of this said, I would like to conclude my session here. As always, it's been a real pleasure joining you, sharing one of my passions with you here. I love the markets, I love trading, I love options. So thank you for joining me. Thank you for participating in the session. Thank you so much, Tiger Brokers, as well, for organizing these powerful sessions with the community. And keep up the good work. And before we conclude, I would like to one more time come to the slides in case you missed it earlier. Let me come here so you can see my email address in case you have any question for me. Also, you can see on the bottom right, on the bottom left, sorry, our social media handles is Trade with UFOs. So find us on social media, like us, follow us, all of those things and beyond, and get your auto climate. You have it for free with a coupon code claim 8. So get your claim 8 to get your climate, and see you in the next session, everybody. Take care, my friends. Trade safe. See you soon, and bye-bye.